I'm not one of these guys who thinks that the United States is going to collapse or anything like that. But I think that we have some trying times ahead of us, irrespective of who gets elected president.
Well, hello and welcome to Assay TV. Today, we're delighted to be joined by mining investment legend Rick Rule, who is the president and CEO of Sprott Global. And he's beaming to us live from his beautiful new home in Washington State in the USA. You moved out of California, Rick.
I did. I wanted to be in a place that was less crowded in my declining years. Not that California taxation had anything to do with it, of course.
Absolutely. Obviously, 2020 has been a very challenging year for everybody. You've been in the sort of equities game for, I believe, 46 years. So when it comes to sort of financial crises and market meltdowns, this isn't, as they say, your first rodeo. What would be your sort of key piece of advice to give to investors as they kind of survey the debris of 2020?
I think the correct way to react to a crisis is to prepare for it for a very long time. I have, for most of my adult life, leaving up the first 10 years, maintained higher cash balances than most people have. That is to say, more liquidity than many people deem prudent. The consequence of that is that when a liquidity crisis happens, when a crash happens, I have both the means, which is to say the cash, and the courage to take advantage of it rather than being taken advantage of. So one thing is to carry more liquidity than some people think is prudent, because although the purchasing power of your cash declines more rapidly than you think over time, the option value of the cash is extraordinary when other people don't have any. I would say the second thing is know enough about your investments that you have the courage of your convictions. If a stock is priced at $10 and nothing fundamentally changes with the company, but the price declines to $5, it is arithmetically twice as attractive at the same time that you're uncomfortable holding it. The more courage that you have in your conviction, the more knowledge that you have, the more likely you are to use the knowledge that you already have and acquire more of a good asset cheaply, which has worked very, very well for me over time. And I would say, with specific regards to precious metals, understand that the big thinkers, the central bankers, the governments, all those people, their policy response to a crisis is always the same: to debase the currency. So currency-related crises, I'm not talking about wars, but liquidity crises, things like that, have a policy response which is invariably good for precious metals. That isn't to say that in the middle of the liquidity crisis, the price of precious metals don't go lower, pardon me. But the policy response from the big thinkers is always the same and always good for precious metals. And I suspect, frankly, less effective over time.
But the policies we've seen in recent years of low interest rates, and in some cases negative interest rates, they kind of go against people holding on to their, building up some savings. And obviously a lack of personal savings has been highlighted as a major problem in this sort of period of lockdown where people have been out of work.
Well, Ian, you've made so many wonderful points. Leo, I'm sorry, you've made so many wonderful points there that we need to unpack them. The first is that the nature of a democracy is a war on savers by spenders, spenders being more numerous than savers. There's a great old libertarian bumper sticker in the United States that democracy is 4 coyotes and a lamb voting over what's for lunch. And so one can count on fiscal policy that favors spenders over savers. That notwithstanding, you have to save. The fact that savings becomes less attractive as a consequence of low interest rates is of no matter, because, as I say, the gradual depreciation of the purchasing power of your savings is more than made up for by the option value of having that cash available to deploy when other people are either unwilling or unable. The 2008 circumstance turned out to be very good for me personally. It isn't to say that it wasn't uncomfortable at the time. The March discomfort that we went through this year was less good for me because it didn't last as long. The truth is that irrespective of the fact that savings is relatively unattractive, given the extraordinarily low interest rates that one is paid, one needs to have liquidity, no ifs, ands, or buts. The fact that the big thinkers don't want you to is all the more reason to do it.
Mm. And I mean, for those who might have missed out on the March drop, looking forward to the year ahead, we have some big sort of political issues possibly coming up with things like the election. I mean, what are your expectations? Is another drop on the way?
I don't know. I'm obviously not a political scientist. I couldn't vote for either party's ticket. I just couldn't do it. It amuses me, I guess, that a country this great has managed to find four so spectacularly unsuitable candidates. But we'll move on from editorializing. What your audience is probably interested in is how it might affect their markets. And my suspicion is that no party is in favor of anything that would resemble sound economics. The Democrats and the Republicans will be involved in a race to debase your savings. They will both engage in quantitative easing. Now, Leo, if you did quantitative easing, they would call it counterfeiting and they'd put you in prison. When the big thinkers do it, it's policy and it's popular and it gets them elected, so it'll continue. Both will continue debt and deficits. No difference between Tweedledum and Tweedledummer on debt and deficits. And that debases the currency too. Similarly, artificially low interest rates will continue under either administration. So my suspicion is that if the Democrats are elected, the ruin will continue and precious metals will go higher. If the Republicans are reelected, the game will continue, the ruin will continue, and precious metals will go higher. My suspicion is that whichever ticket gets elected, that the wind is in the sails of precious metals and that the debasement of the US dollar will continue. That cheery assessment is...
Well, there's not much else that, in their toolbox, really, is there? I mean, what would you do if you were in their position?
Oh, personally, I'd do what Volcker did. Personally, I'd take the bitter pill. It wouldn't take very long to have a reset. If you let the market take control of interest rates, you would bring on a recession. You realize that we were in an economic recovery until COVID for 10 years. That's one of the longest economic recoveries of my career, however tepid that recovery might have been. The idea that somehow the big thinkers can outlaw a reset or a recession would be laughable if it weren't so destructive. So what I would do, of course, is let markets take their course. Now, that would be hugely unpopular because most of the people haven't prepared for the market taking its course. And I remember personally my own portfolio and my career's response to Volcker, which was extraordinarily harsh. That notwithstanding, I learned the seminal lesson of my investing career, which is to say that occasionally markets work. And more people need to learn that.
Absolutely. And if you're holding on to some cash for looking out for these opportunities, in terms of sort of timing your market entry, at a time when everything's sort of volatile, it seems that you should be holding on to your cash even tighter. But you're saying it's those times you need to have the courage of your convictions and make some prudent investments.
Leo, one of my consistent flaws is that I'm extremely linear and extremely rational. And if I believe that A is true and B is true and C is true and D is true and that the likely outcome is Y, unfortunately, I confuse two words in English. One is inevitable, where I'm usually right, and the other is imminent, where I'm usually wrong. So I'm always early on the buy side, and I'm almost early on the sell side. And it turns out over 45 years, that's worked out extremely well for me. Other people might have different points of view. I do believe that in the near term, that precious metals are probably 18 months into a real bull market, not a recovery from an oversold bottom. And while I understand that all markets are cyclical and volatile, but precious metals are extremely volatile, I believe that while we will see cyclical declines in a secular bull market, that this bull market has some reason to run, simply because of the debasement of other forms of savings. And I also believe that the response to the increase in precious metals prices hasn't been accurately reflected in equities prices, except ironically at the very bottom of the quality pyramid. For the last 4 months, the juniors, particularly the nothing nowhere juniors, the ones that have no net present value whatsoever, have been on a ridiculous tear. And the financing market has been truly insane. But if you come up the quality trail, I would say that some of the higher quality companies are really cheap.
Hmm. I mean, when it comes to rational investors, sorry, when it comes to rational investors, I mean, this is possibly where you were, what you were going to come on to. Warren Buffett, no one more so than Warren, looks at a balance sheet and says this company is cheap or expensive, and invests accordingly. Recently, obviously, made an investment into Barrick. What's your take on that?
I think that's very instructive. Of course, many of the gold bugs are saying that now Buffett is changing his tune. I think that's wrong. I think Buffett regards gold as a pet rock and an inert asset. What it says, I think, is much more important. What it says is that you look at the expected value of future cash flows at stable gold prices, because he's not a gold bug. If you look at that relative to the enterprise value, market cap plus cash minus debt, you are buying future earnings cheaply. That's what Buffett looks at. He doesn't care if it's sugared water, meaning Coca-Cola, or credit cards, meaning American Express, or Barrick. He looks at the expected net present value of future cash flows relative to the enterprise value, and he looks at Barrick versus the S&P 500, and he says, despite the fact that I hate their product, I like the company. He also, he's always of two minds with regards to management. He has two famous quotes. One is that there's millions of people in the world who can play basketball, but to win, you got to have a couple of 7-footers. Clearly, Mark Bristow is a 7-footer. He also says about the best company that you ought to buy a business that's so good that it could be run by a moron, because sooner or later it will be. I don't think he feels that way about Barrick. I don't think that he feels like it's a good business for all times. I just think that he thinks relative to the cash it'll generate in the next 10 years, it's cheap.
Before I interrupted you with that question, you were talking about how a lot of the more quality miners are undervalued. Why do you think that is?
I don't know. This bull market, equities bull market, began the way others do, with the best of the best moving first. The gold bugs, having been spanked by an 8-year bear market, wanted to come back into this market in tepid fashion. So they bought the biggest and the best. And the generalist investors, who are beginning to appear in droves, similarly bought the best of the best. What normally happens is that after the best of the best move, the relative values, the best of the rest, and the large single asset producers move next. But that's not what happened. Market leadership moved to the penny dreadfuls. And I mean dreadfuls. I'm not talking about the great juniors. I'm talking about the dross. It really amuses me, frankly, Leo, that all of the gold bugs, myself included, bemoan the central bank's printing of worthless currency units. But the private sector is always more efficient than the public sector. And the Canadian dealer network in particular can print phony share certificates even faster than the Fed can print phony dollar bills. So we have a situation where the speculators in the junior sector, and I count myself among them, need to be very careful. Coming further up the quality chain, if you believe that $1,900 US gold is going to hold, these companies may very well be historically cheap.
I mean, and as we get sort of more sort of quarterly results coming out later in the year, and major companies in sort of more mainstream industries are giving out these terrible results with massive losses. Meanwhile, the mining companies are putting out fantastic results. I mean, surely people are going to take notice of that.
You're right. I mean, you're absolutely right. I don't want to comment on what will happen to general market securities because I'm not a general market analyst. But the truth is that stocks move up because they exceed expectation. And in the year 2019, the expectation for the gold sector was so low that it was impossible not to exceed it. It would have been more difficult to get under the bar than over the bar, including the expectations of management teams. Gold is one of those odd industries where most of the management teams don't believe in their product, except that they know that it's easy, it lowers their cost of capital to be looking for it. The consequence of that is that the management teams have been extremely cautious with their gold price forecasts and their budget. Guys who had a budget that was focused on $1,250 have had a very pleasant surprise at $1,900, surprising them, I think, most extensively. The second thing that folks need to think about, Leo, has been, and you'll remember this, the decade that was 2000 to 2010 featured really farcical investment decisions on the part of mining companies. Stupid acquisitions, ill-fated capital deployment, all that kind of stuff. The industry wrote off tens of billions of dollars. And one consequence of that is that most of the management teams were allowed to pursue other employment opportunities, which is to say the shareholders fired them. That lesson is very fresh on the management teams now. And they've been extremely, extremely cautious with regards to acquisitions and with regards to capital expenditures. They're making capital expenditures based on $1,300 or $1,400 gold. Virtuous circle, they're going to begin to become more aggressive, which will put life through lots of the sector. But it isn't just about the income statements that are improving. The fact that they haven't done anything stupid with that money that flows through the income statement means that those balance sheets are becoming absolutely impregnable. If you look at the balance sheet of, say, a Barrick or a Kinross over the last 24 months, the renovation of those balance sheets has been astonishing. And if you look at the balance sheet and the income statement in conjunction, you understand that in the absence of doing an acquisition or a big capital project, that there are billions of dollars to be returned to shareholders by way of dividends or buybacks. Very, very pretty situation from my point of view.
Are we already seeing some companies increase their dividends?
Yes, I mean, we are. With the rearview mirror, though, we're seeing them increase their dividends, as they should, in fairness, against a $1,250 gold price. With their balance sheet intact, they will need to either deploy their capital at competitive internal rates of return, which would be a good thing, or return the capital to shareholders, which would be a good thing. They have two wonderful choices in front of them.
Absolutely. Are there any particular regions in the world, though, that you can point to that where companies have an advantage in terms of the price of gold in their local currencies versus the cost of production?
Well, certainly almost everywhere. The US dollar, for all of my criticism of it, seems to be the strongest major currency in the world. As Doug Casey is fond of saying, the prettiest mare at the slaughterhouse. So any country whose currency is depreciating against the US dollar has an inadvertent subsidy to the mining industry. The input costs are in depreciating currency, while the product is sold in a stable currency. I would suggest for myself, I'm fairly tolerant of perceived political risk, that the whole circumstance of cost versus sales price versus resource and reserve probably favors Russia. But I realize that Russia is a pretty gamey pick for most of your listeners.
Maybe. But in terms of sort of disruptions from COVID and things like that, are there, some countries have obviously fared better than others, although the mining industry seems to have been able to sort of manage that generally in terms of...
Mining industry has done a spectacular job. Lots of people engaged in physical labor, so breathing deeply in confined spaces, which is to say underground mines. Yes, there were some problems, but relative to the industry's handling in this circumstance and the response that you would have seen 10 years ago or 15 years ago, the industry has done a job that is commendable and frankly very surprising given the challenges they had. I heard very recently from Robert Friedland, a big construction project in Katanga, 4,000 construction workers, not all of them particularly highly educated. And he said, with good management, COVID became a non-issue. He said, we said to the labor force, this is non-negotiable. You are going to be clean. You are going to practice very, very, very safe conditions. And if you aren't, you're going to join the swelling ranks of the unemployed in Katanga. The consequence of that, and perhaps the consequence of Congo having a lot of experience in infectious disease, has meant a circumstance that I figured could have become horrific, being not horrific at all. Was it a management challenge? Yes. Were there costs involved? Yes. Did the industry do a good job? No. The industry's done an exemplary job.
Fantastic. In terms of, but from an investor's point of view, does the travel bans and things like that make it harder for you guys to sort of go and get some analyst boots on the ground on these mines?
Yes. Yeah, absolutely it does. There's no substitute at Sprott for having one of our own geos or one of our own engineers touch the rock or look at the plant. There's absolutely no substitute for that, which is hard. The only thing that I can say is that we're on an equal competitive footing with all of our competitors because nobody is allowing their staff to travel. Now, for me personally, the travel ban has been a good thing. I feel better at age 67 than I felt at age 55 because I'm not flying through 10 time zones a month. I get to speak to your audience from my home in Anacortes as opposed to flying to Cape Town. While I dearly love Cape Town as an example, it's easier on the carcass to do it this way.
Absolutely. I wanted to sort of ask you your opinions on the battery metal space, just to change the mood a little here. Last week we had Tesla's battery day and all the sort of hoo-ha around that. What's your take on the battery sector at the moment? Did Elon's words make change your opinion in any way?
Elon's a great promoter. He's probably more effective than Friedland, which is saying an awful lot. I don't pay an awful lot of attention to what he says because it varies so consistently with what he does. I am attracted to the battery metal sector. The only thing that isn't attracting me to it is the incredible popularity that it enjoys. I do better in sectors that are out of favor. So I really think you need to take it component by component by component. I'm attracted to the copper space for other reasons. I think the electrification of the world and of course, distributed storage will make a big difference to copper, although I'm probably comfortable thinking copper goes lower before it goes higher. But I think at some point in time, we have a really explosive rally in the copper price, one that'll surprise a lot of people. I'm really attracted to the cobalt space, but finding an investable vehicle in cobalt in a country that people other than myself could invest in with a straight face, is a bit of a challenge. Lithium, I sort of do believe that lithium demand continues to rise, but I don't think we have a shortage of lithium. I think we have a shortage of lithium productive capacity, refining capacity. The last time I looked at the SQM annual report as an example, they said at current rates of production, they were down to 80 years of reserves. That doesn't feel like a shortage to me. It feels like there's a processing bottleneck. So I really think it depends on the metal that you're talking about. I mean, I absolutely believe that the electrification of the world and distributed generation and distributed storage and microelectronics, never mind the connection of 1.2 billion people to the grid who are currently unconnected, will do wonderful things for everything associated with the use, transmission, and storage of electricity. I just wouldn't want to get myself too hyped up,
As you say, I mean, it seems to largely be down to the processing capacity. I mean, when it comes to things like nickel or manganese, which obviously people got very excited about after the Tesla announcement, but it's all there's plenty of that around. It's just it's about getting the high purity product,
Sure.
without the impurities and all that sort of stuff that you need.
I mean, I must admit to a decades-long fascination to high quality nickel sulfides. It's a flaw in my character, but they're so rare that I can seldom indulge my fondness anyway.
Absolutely. Let's talk about uranium a little bit. I know that you've been a long-term fan, and as you mentioned earlier, you tend to get into the market kind of sort of quite early. I know you've been talking about this for a while, but the price is still sort of, staying around the sort of $30 mark.
I suspect I'm still early. I think the thing that controls the price in the very near term is the pace of Japanese restarts. And with a tepid global economy and very low liquefied natural gas prices, the Japanese don't need to restart. On the other hand, last year, total world demand exceeded total world demand pre-Fukushima. So the Chinese are generally taking up the slack of the Japanese. But I'm reminded of the simple arithmetic around uranium. And that is, even in a country that thinks it's too rich to need uranium, I'm talking about my own country, the United States, uranium generated almost 15% of total electricity demand last year, and importantly, about 20% of baseload demand. As the California blackouts have shown recently, when you get down to a 3 to 5% redundancy, plurality of supply over demand, you begin to face rolling blackouts. Now, if you look at that 3 to 5% required redundancy, and you look at the fact that uranium provides 15% of US baseload, and then you look at the fact that the incentive price for uranium mines, including the cost of capital and the expensive prior year write-downs, exceeds $50 a pound, the arithmetic becomes profound. You make the stuff for $50, you sell it for $30, you lose $20 a pound 90 million times a year. Either the price goes up or the stuff becomes unavailable. And in the United States, if the stuff becomes available, the lights go out. So your American listeners need to determine 5, 6, 7 years from now, what's the most likely outcome? Will the price go up or will the lights go out? My bet is door A. Will it happen in a year or 2 years? I have no idea. Leo, the last bull market in uranium, I wasn't merely early. I was 4.5 years early. And depending on how you discount your funds, that early is wrong, not early. But the rent I got paid when uranium moved was so extraordinary that almost any discount rate would have been amortized. At the beginning of that market, there were 5 uranium juniors worldwide that had survived a 20-year bear market. The poorest performing of those juniors over the next 5 years, the poorest performing was 22 to 1. So I can't help myself. I'm not saying that past is prologue in that dimension. What I am saying is nobody expects anything from the uranium space, but if you believe in arithmetic, the space has to deliver. And normally when it delivers, what it delivers is, pardon the pun, explosive.
Mm-hmm. Absolutely. And there's not that many companies. I mean, you mentioned that there was 5 back then, but there's still not that many companies around. There was obviously a boom in the number of juniors in the uranium space, but then that's since it's frittered away down to...
The junior population that purported to be in the uranium business between 2000 and 2006 grew from 5 to 500. That's the nature of a mining bull market. Now, interestingly, there were probably 12 to 15 competent management teams. So at the top, the probability that your junior had a competent management team was a function of dividing the number of teams, which is to say 15, by the number of aspirants, which is to say 500. Really profoundly bad math. We're probably down to 20, 25 juniors now. Interestingly, we consider now 10 of that universe to have investment merit, which means that probably 40% of the space is investable. In the gold junior space, I believe that less than 20% of the gold juniors are investable. So if you think about the division of risk through the market, I would suggest that the uranium business likely presents, through some flawed calculus, less risk.
Mm. Obviously, you can't mention sort of individual company names, but what makes a uranium company investable?
It's useful if they have some uranium. Normally, it's just a component in the name that's on the share certificate.
Mm-hmm.
And I like to tell people, if the price of something you don't have any of goes up, it shouldn't have much impact on the underlying value. But much more importantly in the junior is to have a management team that has had success in uranium. I don't care if they were successful in crypto or pot. I want them to be successful at the task at hand. Uranium deposits need to be big to make big money. The upfront time and cost to put them in production is such that the risks associated are enormous. And the consequence of that is that the size of the prize has to be enormous too. So I look to people, I look to scale. There are a couple of world-class deposits sitting in juniors today. Tier one deposits, and finding a tier one deposit reposed in a junior is extremely, extremely unusual.
Absolutely. And I guess if there's only 20 companies out there, it's not going to take more than a sort of an afternoon's worth of digging for people to identify which ones might be, have a better shot.
If they want to short circuit it, of course, they can open an account with Sprott. We'll do the digging for them.
Absolutely. Absolutely. Coming on to sort of one thing we haven't talked about. We've talked about a lot of things here, but people, I guess, will be interested to get your take on where you think the gold price is going to go. Because,
Leo, I'm too old and too smart to give you a price target. I don't know. First of all, because gold is priced in the US dollar, which is in itself a floating abstraction. I don't know what the dollar's worth. So it's very difficult if you know nothing about the denominator and you don't have a numerator to come up with a sum. Here's what I can tell you. Gold does well when people are concerned about the diminution of the purchasing power of their savings in traditional savings instruments, in particular things like the US 10-year Treasury. And anybody who isn't concerned about the purchasing power of their savings in US 10-year Treasuries has lost the plot. I will begin to rethink my precious metals thesis when we have positive real interest rates on the US 10-year Treasury. Traditionally, they have been north of nominal inflation by 200 basis points. I'll revisit my premise when the US federal government deficit is less than 1% of GDP. Or I'll review my premise when the market share of precious metals or precious metals related assets in the United States exceeds 3% of the total market for savings and investment products in the United States. Right now, it's less than 0.5%. It's ironic with wind and precious metal sales that precious metals and precious metals market share of savings and investment assets in the United States is 1/3 to 1/4 of the 3-decade mean. It isn't just that wind is in the sales, it's that the asset class is under-owned, which is hilarious.
Why do you think that is? Is it just because the stock markets have been on such a tear over the last sort of 10 years?
I think that, and I think the fact that recency bias, I think people pay attention to recent evidence and recent pricing signals rather than to history. And the fact that gold hasn't really performed as an asset for some period of time, while bonds have performed extraordinarily well for 38 years, makes people attracted to an asset class, which is to say bonds, where the market is arguably over. They haven't discovered a market that's sort of the antithesis of the bond bull market. But it's good. That sort of attitude makes it easier for an old guy like me to compete.
Absolutely. Absolutely. Final sort of wrap up. If people want to know, when we arranged this interview, we put a message out to people to say, give us some questions for Rick, and we got quite a few people asking us specific specific questions about specific companies, which obviously you can't do. But if people want some more help on this thing, what should they do?
Here's what we can do. Any of your listeners or readers who care about our opinion can visit a web link, sprottusa.com/rankings. They'll find a web form where they can enter their natural resource portfolio. We will not give investment advice, but we will rank the companies by our own criterion, 1 to 10, 1 being most attractive, 10 being least attractive. And I'll add comments where I think my comments might have value. In addition to that, I will send back by return email a 50-year Barron's Gold Mining Index chart, which is a wonderful visual aid to see where we are now in the market and valuations relative to other bull markets in precious metals in the last 50 years. It's just a wonderful chart. And finally, I'll include a 100-year commodity chart, which is a wonderful visual aid to see the valuation of commodities relative to other investment classes and frankly, other asset classes over the last 100 years. Again, I'm no technical analyst. I'm just including this to give people a sort of a visual sense of where we are in these markets in the historical context. It's quite valuable.
Mm-hmm, absolutely. So that was sprottglobal.com/rankings.
SprottUSA.com/rankings.
SprottUSA.com/rankings. And in terms of, you said, these charts will show you where we are in a historical context. In terms of overall sort of market turmoil, how does 2020 rank?
Oh, it started off for every asset class in fairly rough form. The world economy shut down. To be honest, the ability of the big thinkers to smooth things over by pouring in large dollops of cash has and always has surprised me. I'm frankly surprised that the markets have been as benign as they have been. My suspicion is, and I can't speak to markets like Great Britain, but my suspicion is that the first half of 2021 will be a little less generous. I think that you're going to see, the beginnings of a foreclosure crisis. There's a forbearance on foreclosures right now. I think there's going to be a bit of an eviction crisis, and I think there's going to be a bankruptcy crisis. And I think the policy response to that social circumstance will be scary. And I think that people's reaction to all of that will be scary. I'm not one of these guys who thinks that the United States is going to collapse or anything like that. But I think that we have some trying times ahead of us, irrespective of who gets elected president. My suspicion is that people being increasingly politicized will continue to be hostile towards each other. I suspect, unfortunately, that you're going to see violence on the right and violence on the left. And the vast majority of the population who sits in the middle will be rightly concerned about this escalation of social tension, much like happened in the latter half of the decade of the 60s.
Absolutely. So, as we look forward to the year ahead, I guess you'd be saying sort of stay liquid, stay sharp.
Stay liquid, stay sharp if you can afford it. Buy some physical precious metals and look at the relative valuations of precious metal stocks. Prepare yourself. We can talk about this some other time for a truly spectacular rally 3, 4, 5 years from now in industrial materials. Another 2 or 3 years of underinvestment in productive capacity in things like oil and copper means that we'll have a rally in those commodities that resembles the rally that we saw in the first part of the last decade. Not now, but later.
Well, fantastic. Thank you very much for your time today. As always, fascinating insights there into the world of resources investing. Rick, thank you very much for your time today.
Leo, it's always a pleasure. I look forward to seeing you in the flesh somewhere and sharing a pint.
Fantastic.